U.S. economy shows slow growth at a 2.3% annualized rate in fourth quarter of 2024. Trump announces Zelensky's visit to sign a rare earth minerals deal. And Egypt reveals a 200 billion Egyptian pounds social support package. Welcome to the Qnews Economic Bulletin, where we bring you the latest developments shaping the global economy, from key market trends and financial updates to regional economic highlights and forecasts. We provide essential news and analysis to keep you informed. Let's start off with the United States, as the Commerce Department has reported that the U.S. economy slowly grew at a 2.3% annualized rate in the fourth quarter of 2024, down from 3.1% in the previous quarter. The figure matched earlier forecasts, with upward revisions to government spending and exports offset by weaker consumer spending and investment. Consumer spending, which drives over 2/3 of the economy, grew at a solid 4.2% pace. However, growth appears to have slowed further in early 2025 due to severe winter weather, which dampened retail sales, housing activity, and job growth. The Labor Department has reported that the number of Americans filing new claims for unemployment benefits rose more than expected last week, increasing by 22,000 to a seasonally adjusted 242,000. The report also highlighted concerns over mass layoffs of federal workers by Elon Musk's Department of Government Efficiency, though these have yet to impact unemployment compensation data. Economists warn that such layoffs could ripple through the economy, affecting private sector jobs. Meanwhile, continuing claims fell slightly to 1.862 million, and the unemployment rate held at 4% in January. The Commerce Department's Census Bureau has reported that new orders for key U.S. manufactured capital goods surged in January, signaling a potential rebound in business spending on equipment for the first quarter. Orders for non-defense capital goods, excluding aircraft, a key indicator of business investment plans, rose 0.8% after a modest 0.2% gain in December. The increase exceeded economists' expectations of a 0.3% rise. However, shipments of core capital goods dipped 0.3%, while non-defense capital goods orders rebounded sharply by 12.9% after a 5.3% drop in December. Shipments of these goods, which factor into GDP calculations, rose 3.2%. Bloomberg has reported that Trump administration is preparing to escalate restrictions on China's semiconductor industry, building on measures introduced under the Biden administration to curb Beijing's technological advancements. U.S. officials recently discussed with Japanese and Dutch counterparts plans to limit engineers from Tokyo Electron and ASML from maintaining semiconductor equipment in China. The administration also aims to further restrict exports of NVIDIA chips to China, including the quantity and types allowed without a license. The move seeks to align key allies with U.S. restrictions already imposed on American chip equipment firms. U.S. President Donald Trump announced that Ukrainian President Vladimir Zelensky would visit Washington on Friday to sign an agreement on rare earth minerals. The agreement is part of Kyiv's efforts to secure strong support from Trump, who is pushing for a swift end to the conflict between Russia and Ukraine. While Trump confirmed the signing of the deal, he indicated that Washington would not provide far-reaching security guarantees. For its part, Ukraine announced reaching a preliminary agreement to share revenue from some of its mineral resources with the United States ahead of President Vladimir Zelensky's visit to Washington on Friday. The deal is central to Kyiv's efforts to secure strong support from U.S. President Donald Trump, who's pushing for a quick end to Russia's war in Ukraine. Zelensky emphasized that the agreement does not include a debt repayment clause addressing concerns about fairness. Zelensky described the deal as part of broader negotiations and stressed the importance of his upcoming talks with Trump. Ukraine's prime minister has revealed details of a draft mineral deal with the United States, signaling Washington's support for Kyiv's push for security guarantees. However, no concrete commitments have been finalized. The deal, central to Ukraine's efforts to secure U.S. support, would see Kyiv contribute 50% of future revenues from mineral extraction and transportation into a jointly controlled fund with the United States. He announced that the Ukrainian government would authorize the draft agreement later on Wednesday, paving the way for its signing. Can Ukraine and the United States move forward with a critical minerals deal while a significant portion of Ukraine's resources remain under Russian control? With billions at stake, the answer is far from simple. Here's more on the challenge ahead.
A major obstacle stands in the way of a critical minerals deal between United States and Ukraine. Ukraine holds 5% of the world's mineral reserves, resources essential for defense, technology and green energy. But there is a challenge. Much of this wealth is now under Russian control. Ukraine is rich in titanium, lithium, graphite and rare earth elements, materials used in military aircrafts, electric vehicles, and semiconductors. The country ranks 6th globally in titanium reserves, holding 7% of the world's supply. It is also among Europe's top lithium holders and a key player in manganese, iron, and uranium. These are not just valuable commodities, they are critical for the industries of the future. But here is the catch. Roughly 20% of Ukraine's territory, including the mineral-rich regions of Donbass and Crimea, is under Russian administration. Estimates suggest Russia now controls 42% of Ukraine's titanium, more than half of its lithium, and over 60% of its graphite. According to Ukraine's economy minister, resources worth $350 billion remain in territories controlled by Russia. This isn't just a loss for Ukraine, it's a major disruption for global supply chains and a roadblock to U.S. partnerships. For Ukraine, these minerals are more than an economic asset. They are a geopolitical lifeline. The U.S. sees them as a way to reduce reliance on China. But with so much of Ukraine's mineral wealth under Russia's control, the path forward remains uncertain. As Deputy Prime Minister Olga Stefanishyna puts it, Ukraine is indispensable to the global rare minerals industry until Kyiv regains control of its land. This challenge will persist, not just for Ukraine, but for supply chains worldwide.
Joining us from Moscow is the visiting lecturer at the Higher School of Economics, Romy El-Qalyoubi, to discuss the latest developments in the U.S.-Ukraine minerals deal and how feasible it is. Mr. Romy, thank you so much for joining us on the Economic Bulletin. And first off, let me start by asking you, how significant is Ukraine's role in the global supply of critical minerals, and what industries are most affected by its current challenges?
In fact, Ukrainian's role is by no means significant. because the main actor in this field is China. And China is followed by Russia in terms of the reserves of these rare metals. But obviously Trump, who considers China to be the main geopolitical enemy of the United States in the 21st century, seeks to become less dependent on Beijing, and that's why he looks for to get these rare metals from Ukraine and even probably from Russia. And Russia, by the way, confirmed that it's opened to for U.S. investments and for cooperation with the United States, because these rare metals are crucial for the modern economy in the 21st century, which relies a lot on electronics. So in these terms, Ukraine will not be sufficient for Trump.
Speaking of Russia, with Russia now controlling a large portion of Ukraine's mineral wealth, how does this impact global markets and supply chains?
Actually, it does not have a significant impact because, as I said, Russia has the second largest reserve in the world of rare metals. But at the same time, Russia's production does not exceed 1% worldwide, and that's why Russia is not so important in this term. During the Soviet era, the Soviet Union produced 15% of rare metals. But after the largest country in the world disintegrated, there was a problem with supplies change because Russia used to produce rare metals in Kazakhstan and Kyrgyzstan and to recycle them in Estonia and Ukraine. But when one country disintegrated and became 15 newborn countries, there were obviously problems with supplies. So since that time, Russia has never been an important player in the rare metals field.
But sir, Ukraine's economy minister estimates that $350 billion worth of resources remain under Russia's control. What does this mean for Ukraine's economic recovery and industrial capabilities as well?
Actually, now Russia controls eastern Ukraine, and these areas are richest in terms of mineral resources and in terms of agriculture. But at the same time, these areas are not stable from the point of view of security. And that's why it's hard to imagine that American or even Russian companies would go for a long-term projects in this area. Ukraine, if it gets back these territories, obviously can profit from these resources. But on the other hand, Ukraine would need hundreds of billions of dollars to reconstruct the cities that were destroyed during the war. So at the end of the day, it's not clear if it will be economically profitable for Ukraine to get back the lost territories.
Mm-hmm. Now, let's explore the available options from a Ukrainian perspective, given the current situation. How realistic is a U.S.-Ukraine minerals deal, and what alternative strategies could Ukraine explore?
In terms of minerals, it's by no means realistic. But on the other hand, this deal also suggests to make or establish a fund that would get money from port revenues and others. So in these terms, this fund that would be under the American-Ukrainian governance might be useful for Ukraine to reconstruct the destroyed cities, but at the same time, the United States will also get its share, as Trump considers that this support for Ukraine by Biden was futile, and now wishes to get back American investments to American taxpayers.
Sir, you've mentioned China earlier and how the United States aimed to reduce its reliance on China for critical minerals. If you can expand on how Ukraine fits into that strategy and what are the key risks?
A key risk is that the eastern Ukraine areas are not stable from political and security points of view. And when you speak about investments in minerals, this is a long-term project. And so you need to be sure that tomorrow it will be stable situation, there will be no new war, and apparently no one can guarantee that in Ukraine today.
Mm-hmm. Are there any legal or diplomatic avenues Ukraine and its allies can pursue to reclaim control over its resource-rich regions?
I don't think so, because basically, well, Ukraine can claim that this territory is Ukrainian under international law, but on the other hand, Russia would say that there were referendums organized in these territories and that the absolute majority of citizens voted to be with Russia. Apparently, from the international point of view, these referendums are not legal, but on the other hand, the international law guarantees for people's right of self-determination. So, and there is actually a time bomb in the international law which guarantees the right of self-determination on one hand, but also guarantees integrity of the states on the other.
That was the visiting lecturer at the Higher School of Economics, Rami El-Qalyoubi. Thank you so much for your insights and for all the information you provided us with. And now we move to the latest developments from around the world. Moving to Europe, French Finance Minister Eric Lombard stated that the European Union would impose similar tariffs if the United States maintains the 25% duties announced by President Donald Trump. Lombard's comments highlight the European Union's readiness to retaliate in response to U.S. trade measures, signaling escalating tensions in transatlantic trade relations. National Statistics Institute has reported that the Italian business morale declined in February, with the composite business morale index falling to 94.8 from 95.7 in January. Only the manufacturing sector saw a slight improvement, rising to 87. In contrast, consumer confidence edged up to 98.8 from 98.2, beating forecasts. The mixed data reflects ongoing economic uncertainty in Italy, the Eurozone's third largest economy, amid weak German consumer sentiment is set to decline in March, defying expectations for a slight improvement, as households remain cautious about the economic and political outlook in Europe's largest economy. The GfK Consumer Sentiment Index fell to negative 24.7 points, down from a revised negative 22.6 points in February and below analysts' forecast of negative 21.4. The drop reflects growing pessimism among consumers, with income expectations hitting a 13-month low due to higher prices, economic uncertainty, and political dissatisfaction. Households' willingness to buy also fell to its lowest level since June. In Asia, China has accused Taiwan's government of attempting to leverage the island's semiconductor industry, including TSMC, as a souvenir to seek political support from the United States. According to Chinese officials, there are concerns in Taiwan that TSMC, the world's largest contract chip maker and a major supplier to companies like Apple and Nvidia, could effectively become the United States semiconductor manufacturing co. The Chinese government spokesperson claimed that Taiwan's ruling Democratic Progressive Party is freely making demands from external forces and using Taiwan's semiconductor industry and powerful companies to get a foot in the door to relying on foreign countries to seek independence. Hong Kong has announced plans to cut 10,000 civil service jobs by April 2027 and freeze public sector salaries to tackle a rising deficit, which hit 87.2 billion Hong Kong dollars due to plunging land sales revenue. Financial Secretary announced the measures in the city's annual budget, aiming to reduce public spending by 7% over 5 years. The budget also includes a 1 billion Hong Kong dollars investment in an AI research institute, aligning with China's push for tech self-reliance. However, critics say the plan lacks structural reforms to address long-term fiscal challenges. Thailand's central bank cut its benchmark interest rate by a quarter percentage point, lowering the one-day repurchase rate to 2%. The move, approved by a 6-1 vote, aims to address a weaker growth outlook and rising risks from global trade uncertainty. The decision follows repeated government calls for easing to support the economy and weaken the baht to boost exports, a key growth driver. The central bank cited slower gross domestic product growth and structural challenges in manufacturing as reasons for the cut. Further in Africa, Statistics South Africa has reported that the country's inflation rate edged up to 3.2% year-on-year in January from 3% in December. The figure, which follows an update to the consumer price basket, remains near the bottom of the South African Reserve Bank's target range of 3% to 6%. Annual core inflation, which excludes volatile items like food and energy, held steady at 3.5%, in line with analyst expectations. The central bank has cut interest rates at its last 3 meetings, but signaled caution in January due to global uncertainty. Going to Egypt, the Egyptian government has unveiled a 200 billion Egyptian pound social support package to assist citizens grappling with rising prices. Prime Minister Mustafa Madbouli announced that the measures will include a 15% increase in pensions starting in July, raising the minimum wage for state employees to 7,000 Egyptian pounds per month, and a 25% boost in cash support for beneficiaries of the Takaful and Karama program. Additionally, farmers and vulnerable families will receive targeted assistance. The total cost of the package is estimated at 40 billion Egyptian pounds over the next 2 months, with wage increases alone costing 85 billion Egyptian pounds in the next fiscal year. Oil prices rose more than 1.5% on Thursday as supply concerns resurfaced after U.S. President Donald Trump revoked a license granted to U.S. oil major Chevron to operate in Venezuela. Gains were capped, however, by signs of a potential peace deal in Ukraine, which could result in higher Russian oil flows and an unexpected rise in U.S. gasoline and distillate stocks. Brent crude oil futures were up 1.5% at $73.63 a barrel. U.S. West Texas Intermediate crude oil futures rose 1.7% to $69.76. Gold prices dropped to their lowest level in over 2 weeks on Thursday as the U.S. dollar strengthened, with investors waiting for key inflation data that could shed light on the Federal Reserve's monetary policy path. Spot gold was down 1.2% at $2,882.49 an ounce after hitting its lowest level since February 12 earlier in the session. Prices hit a record high of $2,956.15 on Monday, driven by safe haven flows. U.S. gold futures lost 1.2% to $2,894.50. The dollar index rose 0.7%, making greenback price bullion more expensive for holders of other currencies. In the stock markets, global shares showed a mixed performance on Thursday. Futures for the S&P 500 inched down 0.08%, while those for the Dow Jones Industrial Average hiked 0.78% in Europe. France CAC 40 was down 0.59%, and Germany's DAX decreased 1.10%, while Britain's FTSE 100 hiked 0.25%. In Asia, Hong Kong's Hang Seng Index dipped 0.29%, while the Shanghai Composite rose 0.23%. The Nikkei 225 increased 0.30%. That's all for now. Here's a wrap-up of what we've covered. U.S. economy grows at a 2.3% annualized rate in fourth quarter of 2024. Trump announces Zelensky's visit to sign rare earth minerals deal. And Egypt reveals a 200 billion Egyptian pound social support package. This concludes our economic bulletin for today. Don't forget to follow Q News on YouTube, Facebook, X, Instagram, and TikTok at QNewsEG to stay informed. Thank you for watching and stay tuned for more updates on Q News.